Hello and welcome to Election Countdown, our weekly series of broadcasts in the run-up to the UK general election. Joining me today is John Bowler from the Economist Intelligence Unit. John, we're going to talk today about sterling and gilt. I'm going to start with sterling and ask whether or not the general election process is having a negative sentiment, or generating negative sentiment rather, on sterling.
There's an old saw that financial markets don't like uncertainty, and I think that is the case at the moment. Over the last decade, funnily enough, when the economy was growing steadily, we had low inflation, public finances were in a good state, the prospect of election was really shrugged off by financial markets. But I think it's different today because we're aware very acutely of the challenges that governments in the West, and notably the UK government, face in restoring order to the public finances and credibility with the financial markets. So I think the fact that at the moment there's this uncertainty about what kind of stance the incoming government is going to take to the public finances is an additional factor bearing down on sterling.
So once the general election is over, do you think that this negative sentiment we've been talking about will necessarily lift?
I think there's a good chance of that, but of course there are some structural challenges facing the economy. But I think in the immediate aftermath of the election, financial markets will be looking for a clear direction from the incoming government about what they're going to do in terms of restoring order to the public finances. One thing that they're going to be frightened about is the prospect of a hung parliament, which is a possibility. You know, the polls which had showed the Conservatives with a fairly comfortable majority over Labour in recent months have shown that, you know, that lead has narrowed. And so, you know, if we were left with a hung parliament, there'd be question marks about whether you'd have a decisive, a government able to take decisive measures. And of course, in recent days, we've actually seen civil servants drafting a plan to show the kind of arrangements that would prevail in the event of a hung parliament, so that the country wasn't left with, without a prime minister following the elections.
And do you think if the next government doesn't get to grips with public debt, then the gilt market really is an accident waiting to happen?
I think that at the moment, if you look at the gilt market, things look okay. We've actually seen gilt yields rise over the last few weeks, but that's been happening elsewhere. And with the 10-year gilt currently yielding about 4.4%, you could say, you know, what's the problem here? But of course, in the last financial year, the Bank of England was a huge buyer of gilts. And the Bank of England has announced that it's going to be withdrawing from these exceptional monetary measures under which it was buying most of the gilts issued by the government. And so it does raise the question, you know, who's going to emerge to buy these securities. But it is the case that you know, there is an underlying demand from financial institutions in the UK, notably pension funds, which have long-term liabilities which they need to match. So they're a natural buyer for gilts. And it's also the case that the government has been fairly prudent in the way that it's managed its debt issuance over the last few years. So it's in the good position of having a long average maturity of the debt of something like 13 years. So that does give it a bit of breathing space.
What implication then would a backup in yields have for the public finances and the wider economy?
It would have fairly serious implications for the wider economy and also the public finances. Now, looking at the public finances first of all, As I said, the average maturity of the public debt in the UK is long. I think it's probably the longest in the OECD. And that means that it would take some time for an increase in new borrowing costs to actually start, impacting the public finances. Having said that, the UK is running very large fiscal deficits at the moment. I think the projection this year is something of the order of £170 billion, which is, more than 10% of GDP. And so that new borrowing at a higher cost would obviously have an immediate impact on the public finances. But as I say, the fact that the average maturity is long does provide some breathing space. I think in terms of the broader economy, it could have a very severe impact, because not only do we have this problem of a severe increase in public indebtedness to deal with, but we have this sort of structural over-leverage in the private sector. And so financing costs are really crucial here in the UK. And so if we saw the rate on government securities, the so-called risk-free rate, increase, that would knock through into the cost of credit to households and companies. And so mortgage costs would increase, and the cost and availability of financing for companies, which has been one of the constraints on the economy over the last 18 months, that would be exacerbated as well. And so I think that would have a severe negative impact for growth and demand.
Thank you, John. So a clear message there then that a hung parliament and any resulting instability could have a very negative impact on investor sentiment. Join us again next week for another edition of Election Countdown.